Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks jumped Monday on optimism that President Trump may hold back from implementing some of his wide-ranging tariff plans, and in the process, the U.S. could skirt an economic slowdown from a protracted trade war. We're going to dive into the rest of the day's market trends straight ahead. Then stocks moved higher today, but that could all change tomorrow. We're going to tell you what to expect from Tuesday's consumer confidence data. Plus, March Madness in full swing, and that means it's a good time to be a betting platform. We'll take a look at how some of the biggest players are faring. Well, for our chart of the day, we're looking at which income bracket owns the lion's share of U.S. stocks, and Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this is a very important chart because it ties back into consumer spending and has implications for the U.S. economy. So let's get to it here. This chart coming to us via Bloomberg, it looks at U.S. stock ownership by income percentile. So what you're seeing here in the sort of light gray, this is the top 1% of income earners in the United States and the share of the stock market that they own, which is quite significant. Add to that the next 19%. So together, these two are the top 20%. You see, they own really the bulk, the vast bulk of stocks here in the United States, with the remaining bit, sort of the remaining percentage here of the remaining 80% holds just a small sliver of stocks in the United States. Why is this important? Well, because we've seen stocks fall here. And so you hear a lot of talk about the wealth effect. That is, as stocks go higher, the wealthy Americans feel wealthier. And that constitutes a big chunk of folks here who do a lot of spending in the United States. According to a recent analysis by Moody's Analytics, in fact, the top earners in the United States, folks who earn more than $250,000 a year, account for half of all U.S. consumer spending. So if this cohort does not feel as confident, and you see a decrease in that sort of wealth effect, that can have a real effect on spending. Just to put a fine point on this and to look at what we have seen from stocks here, we saw, of course, year to date, this slump in stocks. But if you take it back over the past 5 years and you look at the increase in wealth that we saw really starting in 2020, even if you go back and look at the 10-year chart here to see that big boost from 2020 and beyond, there is some analysis that shows that increase in wealth, and obviously it doesn't just track to the S&P 500, it tracks to other assets as well, crypto, etc. That was an enormous increase in wealth on the part of the highest earning Americans. And therefore, to go back to our chart of the day, their ownership of stocks increase. So in other words, Josh, there is a lot at stake if we see a resumption in declines in stocks, because it can affect consumer spending, it can certainly affect consumer confidence, and it has implications for that wealth effect.
All right, thank you, Julie. Appreciate it. Well, policy uncertainty has put a damper on consumer state of mind over the health of the economy, and our next guest noting that on average, consumers appear to be doing just fine. Morning Consult economist Sophia Baig joins us here to discuss. Sophia, it is good to see you. So you all over there at Morning Consult, you have your own gauge, Sophia, your own measure of consumer sentiment. What is it telling you? And is it broadly tracking the University of Michigan's?
Yeah, so our measure of consumer sentiment is actually replicating that of the University of Michigan. So it's made up of those same 5 sub-indexes. 3 of them are based on future conditions for the economy, so future business conditions and future personal finances conditions, and then 2 are based on current personal finances and buying conditions. So it's the same measure as the University of Michigan's Consumer Sentiment Index, but we survey it every day with thousands of respondents and many demographics. So we're seeing similar things to them, but we're able to track it on a more daily basis to see the changes more quickly.
And broadly, Sophia, are you seeing that sentiment? Has it been souring? And if so, what are the reasons? What do people tell you?
Yeah, so the big trends that we've been seeing over the past few months, we saw that consumer sentiment index actually jump up right after the election. Many saw President Trump as the business-friendly candidate and expected a strong economy. So it jumped up. But what we've seen over the past few months and weeks is that sentiment measure has been slowly declining to the point now where it's erased those post-election gains. And that started right the week after inauguration, as some of these policies started to become unveiled. Increased uncertainty became rampant in the business community and elsewhere, with tariffs being rolled in and rolled back. And so sentiment has been declining. And that's been coming from those future expectations primarily. So what people are seeing for the health of the economy going forward.
And Sophia, is it souring for everybody, or can you spot in your data differences? Some more sour than others, depending on variables, whether it's income or political affiliation?
Yes, definitely. There's always different changes based on demographics. You mentioned right before this segment, the high-income consumers are more likely to be invested in the stock market, so they're more sensitive to stock market changes. But another thing that's a recent trend, it's always affected consumer sentiment, but now more than ever, is partisanship. So Republicans and Democrats move in opposite directions. Even right after President Trump was elected, Republican consumer sentiment immediately went up and Democrats immediately went down. And then at inauguration, we saw the same effect. It went up even further for Republicans and it went down even more for Democrats. But what's interesting is those independents who are in the middle, they're kind of following more this average trend of all adults. So they went up slightly after election, thinking good economy was coming, but after inauguration, theirs also went down. Not as much as Democrats, but they're feeling a little bit wary about the economic policies being laid out by this new administration.
So broadly, maybe a shift here in vibes, Sophia, but how are people actually doing, though, financially, based on the data you're getting?
Yeah, great question. So as I mentioned, the big changes that we're seeing in sentiment are really focused on those future expectations portions of consumer sentiment. When we're looking at the actual current personal finances indexes, that one's been climbing up for quite some time now. The trend is upwards and it continues to get better. So what we're seeing is basically a difference in what's going on right now versus how people are feeling about going forward in the economy. So, inflation is not at the Fed's target yet, but it's a lot lower than it was at its peak. Wages, they're not growing as strong as they were when they were roaring, when the labor market was super hot and super tight, but it has been growing faster than inflation for the past year and a half or so. So consumers are doing pretty well. Spending has started to slow down somewhat, which is spooking investors in the market a bit, but it's not completely cool. So overall, I would say the average consumer is doing okay.
Well, finally, Sophia, what is the relationship ultimately between sentiment, which you're tracking here, between sentiment and actual spending?
Yeah, so that relationship is not super tight. We actually have another measure using the current personal finances portion of sentiment and our unemployment index that we call the Consumer Health Index. And we find that to actually be a little bit more in line with how consumers actually spend, because it's taking into account how they feel about their current personal finances today, which is influencing their spending, as well as their employment situation, which can also influence their spending because it's the amount of money they bring in. Whereas consumer sentiment can be a little bit muddied sometimes by things that are happening in the politics sphere, expectations for the future. And it's very sensitive to things like gas prices and groceries, which can make consumers feel bad, but it doesn't necessarily mean that they will change their spending.
Sophia, thanks so much for your time today. Love having you on the show.
Thank you.
Stick around. Much more Ask for a Trend still to come. Stocks close higher with the Dow rising nearly 600 points. Investors hoping President Trump will dial back the next tariff wave. And here with the Trade Day takeaways is Yahoo Finance's very own Josh Schaefer. Josh.
Yeah, Josh, so that was certainly takeaway one, right? So we had news over the weekend reported by both Bloomberg and the Wall Street Journal that perhaps the tariffs that we've been talking about might not be as widespread from the Trump administration. Then, of course, we flip over to the market action this afternoon. President Trump himself speaking in the White House today, and he said that the tariffs might not essentially be as wide as people thought. Maybe not everyone is getting the full brunt of these tariffs. The market opened higher on the reports. Trump spoke about here still had stocks higher off of that. So I think what we're learning here is the clear bias that we've been talking about over the past month, really, which is the market is not necessarily rooting for these tariffs. The market is rooting to hear that the tariffs will not be as widespread as feared. So you get that news today, you get a stock rally, and overall it seems like maybe still a little bit of a wait and see. Remember, we've been talking about April 2nd as that deadline that's still looming next week. So we have right now what the administration is saying, what's being reported on, but no real concrete signed actions to sort of run off.
And investors, they look at a day like today, Josh, and they just wonder, okay, so how, a move like that, how sustainable is that?
Yeah, I mean, I think a lot of strategists right now are saying, let's wait and see, right? So you take a look at something like ARK. This is Cathie Wood's fund, of course. You look over the last, we'll go month here if I can, month, yes. It was one of the most hit sides of the market, right? And so you see a big pop today, not really surprising. I think you even go on a stock by stock basis here, Josh. You look at a stock like, let's point out Tesla, right? All right, so Tesla has gotten absolutely crushed over the last 2 months. Stock rises 12% today. The question is, what are we going to hear that actually gets the stock back up to levels where it was trading? And I don't think that's just going to be tariff news either. These companies are going to have to come out with earnings in the next couple of weeks. I think it's a little bit still wait and see until you hear from some of these larger companies and hear exactly how tariffs might impact them and just the overall environment as we've sort of been in this shifting narrative. I think we want to learn a little bit more over the next month with earnings.
All right, Schaefer, bullet point number 2.
Bullet point number 2. So this was our chart of the week on the website recently, Josh. I want to talk a little bit more about it. So what we're looking at here is the S&P 500 for the year, right? That's, of course, your white line here. Hasn't been that great for stocks. But then you take a look at the forecast. What stands out to the forecast, so we talk a lot about those S&P 500 targets. Your highest one here is 7,100. Your lowest one is 5,500. And then you've got all these ones in the middle. Interesting to think, to get to the high end of this, Josh, you would have to rally over, or I guess before today, about 25%. A lot of the other ones I circled in the middle here, about 10%. And then even 5,500 isn't that low from where we are now. So just what stands out to me right now in the forecasting space is you could really make a good argument for essentially any of these targets, which has not been the case over the last couple of years, right? We've been talking about strategists just chasing the market higher, chasing the market higher. Well, this year there's sort of a case for stocks increase a little bit, stocks increase a lot, or even at 5,500, that's Stifel's Barry Bannister. He's talking about stagflation, higher inflation, slower growth. That's a narrative we've been talking about that is a realistic option at this point, as well.
So those are the targets. Let's talk about profit expectations. What are those doing?
Yeah, so as we know, the market obviously has been moving lower recently, and I thought this chart from Morgan Stanley was interesting. So what we're looking at here is Mag 7 earnings revisions breadth, so sort of where the Mag 7 earnings expectations have been. Remember, Mag 7 led us lower over the last month from a stock perspective. So too did earnings. But what Morgan Stanley's Mike Wilson is pointing out here is this little line. Over the past couple weeks, earnings have started to rebound. Earnings revisions have started to rebound for the Mag 7. If that continues to happen, then maybe going back to a screen we just talked about with all those Mag 7 names being sold off, maybe you see a little bit more of a rally. So it'll be interesting to see again over the next several weeks, not what the companies say about the first quarter, but what they say about the rest of 2025. How much are companies going to cut guidance for the rest of the year is sort of the looming question heading into first quarter.
Tariffs important. We should be talking about that. So earnings.
Yes.
Thank you, Joshua. Appreciate it. Stick around. Much more Ask for a Trend still to come. Well, the first weekend of March Madness has come and gone, and along with all the upsets and buzzer beaters, one big winner has already emerged: sports betting platforms. That's because the American Gaming Association predicts fans are going to bet a whopping $3.1 billion on the tournaments this year. That would be up $400 million from last year. Joining us now is Jordan Bender, Citizens Senior Equity Research Analyst. Jordan, it's always great to have you on the show. So let's start big picture, Jordan. March Madness. When we talk about this event, talk about the tournament, Jordan, how important is it for the sports betting companies you cover? For investors, can you help quantify it for us?
Josh, good to see you as always. This is a really important time of year for colleges, anyone with a bracket, as well as the sports betting companies. We estimate that around $3 to $4 billion will be wagered over the course of March Madness. If we compare that to a Super Bowl, the Super Bowl we estimate did about $1.7 billion. So, obviously a lot more games, but about double the size of the wagering pool. Now, we're only a couple days in here. We think that the first quarter here for the sports books are tracking in line to maybe better than expectations. Now, we don't know the early results, and we still have a couple games left within the first quarter. So the remainder of this week should be important for these companies. But overall, it's a fairly good size, wagering pool for these companies to start the year.
And the companies you cover, Jordan, were they doing anything different this year versus, last year's March Madness in terms of the experience, what they were offering customers?
Yeah, it's this sector is built around product and technology. Who can offer the most ways to bet, how you can bet, where you can bet. We were actually with DraftKings last week, and kind of what they were talking about was they think they had the most products, so ways to bet, players to bet on out in the market this year. So, as we've seen this sector really evolve over the course of the last 7 or 8 years, it's been about how many ways you can get people to your platform and how many ways you can get them to bet. So that's always been the name of the game, year after year, sport by sport, it will always continue to evolve that way.
And Jordan, following March Madness, then you'll have baseball, but it is a relatively, quieter period for these companies. How do they navigate that?
Yeah, this is what we kind of think is the end of the height of the sports betting calendar. You have football, you have March Madness, which we talked about the size of, the wagering pool for that. But you do start to go into a seasonally slower part of the year during the summer with MLB, with NBA and NHL playoffs. From a wagering per game perspective, it's not as important from a seasonal point of view. But we think that, as the year goes on back into football season, Josh, as you talked about with product evolution, they'll continue to put out product through the summer for MLB and then as well as into the NFL, starting in the fall again.
Kind of a broader question for you too, Jordan. Investors have been more concerned about U.S. economic growth, about whether the economy is going to slow down or potentially something even worse. What could that mean for the sports betting companies and their businesses?
So there isn't all that much data because, like I said, this industry's only been around since 2018, at least here in the U.S. From what we can tell, Nevada has been around for a while, as we know, with casinos, with sports betting. The data is somewhat limited, but we do think that this is going to be a recession resilient type of industry. It's a low form of entertainment for what you're actually spending. In Nevada during the Great Recession, handle was only down about 2 to 3%. So, as we've seen in the last couple of weeks with all the tariffs and investors trying to assess how will this impact the gambling sector, and then within that, the online gambling sector, we actually point to this, this area of the consumer industry as something we think could continue to actually grow through a recession, just given the legalization and the continued penetration to some of these states to acquire sportsbook customers, as well as, again, it's a low form of entertainment that we think people will continue to do through tough or turbulent times.
In terms of the competitive landscape, Jordan, you always think about FanDuel and DraftKings, and we've talked about this on the show before, and then kind of BetMGM taking the bronze. Is that still the case, or has there been shifts there?
It's always been 1A and 1B, and it's always been DraftKings and FanDuel. Those two companies have, at least on the sportsbook side, have comprised about 75 to 80% of the market share in the United States. So between them and their next competitors, there's always been a huge, massive difference. However, Fanatics is the company that we're watching. They've built up their business around, they have a database of 75 million people who have bought apparel or merchandise through them, but they've also really dug into the VIP section of the sports betting ecosystem. So very high net worth individuals, and they're actually within striking distance of BetMGM, who currently holds the third place spot. For that third place spot, again, there's still a wide gap between the top two companies, but they're making a move. At this point, we don't really see them as too much of a threat to take over the 1 or 2 spot.
Jordan, always great to see you and to have you on the show. Thanks for joining us.
Thanks, Josh.
All right, let's take a look now. What's trending here in the after hours? KB Home missing first quarter earnings and revenue estimates. Company also lowering its full year housing revenue forecast, falling short of Wall Street's expectations. KB Home citing a lower level of net orders in the first quarter as a reason for slashing its outlook. Oklo stock sinking after hours. Shares closed today up nearly 14% after announcing progress on an application with the U.S. Nuclear Regulatory Commission, but shares are dropping now after reporting full year 2024 financial results. Another sign the IPO window may be opening, eToro filing for an initial public offering, that company choosing the NASDAQ for its listing and planning to use the ticker symbol ETOR. And finally, Boeing reportedly seeking to withdraw a guilty plea as part of a deal made with the Biden administration. This is according to the Wall Street Journal. The deal was part of the government's long-running criminal case against the company for deceiving regulators before two deadly crashes of the 737 MAX jet. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.